Welcome back, and let's move on. Another special conversation lined up for you, our viewers. Jim Walker of Alithea Capital discusses the global macro chaos. He says that advanced economies are entering a difficult and slower growth phase, with money now looking at emerging markets, including China and India. He adds that the AI bubble could soon burst, and selling India now would be strategic madness.
I think that divergence is already here. The Fed has been cutting interest rates this year. The 10-year bond yield is basically the same as it was in the summer. In other words, there's been 2 interest rate cuts since then, and the 10-year yield really hasn't recognised those cuts. You always get much more of an impact at the shorter end of the yield curve when the Federal Reserve cuts. So, of course, the 3-month, 1 year, 6-month, 1 year, those kinds of interest rates have been coming down. But as you get further and further out the yield curve, there's no reaction. How many rate cuts in 2026? I mean, it's going to depend a lot on the inflationary and the growth outlooks, as well as, of course, the political pressure. Now, we know the political pressure is for rates to come down, so that there's undoubtedly going to be rate cuts next year. I think the problem is that the inflation numbers don't support that. And if the inflation numbers don't support it, there is going to be this divorce between the Fed funds rate and bond market yields. But we can pencil in, I think, probably 2 to 3 interest rate cuts of 25 basis points during the course of 2026 as almost being a given. And most of them will be front-loaded into the first and second quarter.
Do you see the spending on artificial intelligence or AI, which has been pegged between $300 to $500 billion over the next few years, to significantly cool off? Because already there are concerns with respect to how this spending will be funded through. Earlier it was expected to be done through the cash flows. Now companies are talking of raising debt to fund this kind of investment, and that's causing some concern for the investors.
Yes, absolutely. It's causing concern because they'll now be in competition with the government in trying to raise debt for their spending. And I'm not quite sure which of the two, either governments or AI spenders, are going to have the best return on the amount of money that they're spending. We know that the government has almost no return on the investments that it makes, quite often, and the spending that it does. And I think that will be true of a lot of the AI spend as well. There will be very little return. But as I say, it's actually not so much the spending there. I'm sure that a lot of people are willing to either go down the debt route or even the equity route to try and increase the spending, the capital spending from the AI companies, the data centers, etc. But the problem with the data centers is that they can spend as much as they like on data centers. They can build as many data centers as they want, but there isn't any electricity in the United States to actually feed the data centers. The talk at the moment is that over the next 5 years, they expect the US installed capacity to increase by 800 terawatt hours. The installed capacity at the moment is 4,000 terawatt hours in the United States. So, in other words, they're looking for a 20-odd% increase in the installed capacity. In the last 20 years, there has been 0 increase in installed capacity in the United States. So this is moving from an industry and a part of the economy that has had 0 growth for 20 years to expecting it to absorb 20% growth in the next 5 years. Now, the problem with that is that, A, the number of workers that have skills to be able to build the generation stations, then the transmission cables, and then the distribution networks are non-existent. They don't exist. There's a shortage of workers already in the US. So the big problem going forward for the AI industry is not so much the new economy that it creates and the big fanfare about the future of artificial intelligence and how that's going to change the workplace and the lifestyles of everybody around the world. The big problem for it is that it's got to get the old economy in line with this new economy future. And the old economy is basically energy and skills, neither of which exist to build the future.
Jim, we've seen a lot of flows going into the US market led by tech and AI in 2025 as a bit of a cool down that comes into play into Mag 7 or some of the tech stocks. Do you see a reverse flow of money going back into emerging markets and some other Asian markets?
Absolutely. I think the sooner that some of the investors realise that they've made a tremendously bad bet on the technology sector in the US and in technology companies, what they really should be buying are steel fabricators, cable manufacturers, the copper industry, copper itself, electric utilities. That's going to be the real source of investment return over the course of the next 5 to 10 years. All of the technology guys are going to be chasing returns and very unlikely that they're going to make any. So I think this is a real opportunity for emerging markets to stand out against the problems that are going to arise in other parts of the asset bubble that has been blown over the course of the last few years. And that really means coming back to the domestic policies and what's happening in places like China and India. We as a company have our global strategy long in those two countries, long China, long India, because of the domestic changes that are happening in both of them.
And how do you see India, playing its role within this entire geopolitical and macro setup which is there? We are growing at more than 7%. The deficits are low. The interest rates are, also on a lower side, and consumption boost which is there. But what we have seen in the last 12 to 14 months is a lot of outflows of foreign money going out of India. Do you see that getting reversed anytime soon, with money going back into India and some of the sectors, despite the fact that the valuations have held up after a lot of outflows?
Yeah, I mean, I'm astonished that foreign investors are selling their India holdings and their India positions. It's just, in my view, madness. That you would be selling down the fastest major economy in the world, with a very bright outlook for the future, and especially given some of the domestic changes that are taking place in India just now as regards the labour laws, the GST, and hopefully eventually the Factory Acts, which will, I think, generate tremendous domestic growth. That's the kind of country that I would have expected investors to be piling into. Instead, what they've been doing is taking profits in India. Of course, they did have plenty of profits, and trying to chase a story in the advanced economies that is going to come to nothing. It might take them another few months, if not a few quarters, to realise that they've just made a gigantic mistake. And that they should have been keeping their India investments and actually doubling down on them and putting more in.
Jim, you've been an India watcher for many years. What do you think, could be a headwind for India going into 2026?
Well, the biggest headwind is probably sentiment. The market hasn't done a tremendous amount this year. Over the last few years, everybody has complained about high valuations. Personally, I never really understood that argument, because the growth is there and therefore the high valuations are going to come down as time goes by. But apart from the sentiment, the biggest potential drawback for India just now is really just not getting that momentum behind domestic legal changes. to the structure of the economy. The Reserve Bank has done a great job. There's nothing else that they can do. There's really no need to be cutting interest rates further at the moment in India. The government has done a fantastic job in terms of its fiscal priorities. It's pushed much more money into capital expenditure in the economy, roads, railways, ports. That's exactly what government should be doing, and if it's going to spend at all, that's the kind of area that you want it to spend on. But the real kind of test now is the if you like, ease of doing business structure in India. This has always been a bit of a problem in terms of labour laws and factory acts. The labour laws have been addressed this year, and I think that's great news. GST has been rationalised and lowered, and I think that's great news. And the next thing that really needs to happen is for a lot more of the red tape around company formation, industrial policy to be removed, and then let India rip as a domestic growing economy. We shouldn't be looking for India to use the export promoting growth strategies of the rest of East Asia. I think that would be I think an abject failure if that was the route that people were trying to go down. This is a domestic story in India, and it's going to be a domestic story in China going forward as well. It's the saturation point has been reached in a lot of markets in terms of export promoting growth. So it's all down to governments and to central banks and bureaucracies to make it easier for businesses to happen in the domestic economy. And I think that's the next big thing in India.
Biggest thing that has hit India from an external sector is the India-US tariff, which has come into play. Do you see that settling in 2026 and to a level where trade resumes back to normal between the two countries?
It's a difficult one to call because, as you know, the tariff policy has now been sent to the Supreme Court in the United States. It might well be that they will decide that tariffs have been illegally imposed by the administration because it really isn't in the ambit of the president to put tariffs on. That has to be passed through Congress. So it could well be that all of these tariffs actually disappear over the course of the next few months. But let's say they don't. Will things settle down? Yes, things will settle down. People will get used to the higher tariffs. Trade will be affected. But at the same time, countries, and China is a very good example of this at the moment, countries will find different trading partners in different ways to effect the trade even into the United States. Some countries don't have any tariffs with the United States, Singapore, for example, because it runs a deficit with the US. So people will be trying to increase their exposure, increase their plants and their manufacturing base in countries like that, Singapore being one, but that's a tiny country. India will, I hope, look for new markets and different trading partners. And hopefully the BRICS region, if you like, is going to be one of those trading partners going forward. You can't trust the United States to actually be making economic sense over the next few years. It's going to be one step forward, two steps back, maybe sometimes two steps forward, one step back. But it's going to be a very tricky path to negotiate with the United States in the mood that they're in just now. So hopefully it's things will settle down, but it'll be with other trading partners rather than with the US.
Jim, when we speak about emerging markets, we talk about commodities. Oil, for one, has been very muted in 2025. And that has helped countries like India in some way, but at the same time you have gold, which is rising, and that's creating some bit of balance of trade there, the problem for the country. How do you see both these commodities or asset classes, gold and oil?
Yeah, let me start with oil because I wouldn't be able to answer the question. I used to be an oil analyst at the Royal Bank of Scotland in the 1980s, and I think every single time I made a forecast about the direction of the oil price in the next year, it was wrong. Oil is the hardest commodity to forecast direction with.